Today is Monday, February 10th, 2026, and something extraordinary just happened in the global currency markets that most investors completely missed. The dollar index closed Friday at 98.47, its lowest level in 18 months. Gold broke through $500 levels for the first time in history. And buried beneath these headlines, a pattern emerged that currency strategists have been tracking for over a decade. The pattern that preceded every major monetary crisis of the past 50 years. Right now, central banks across the globe are making moves that contradict everything they're telling the public. They're saying inflation is under control. They're claiming economic stability, but their actions tell a completely different story. In the past 90 days alone, central banks have accumulated more gold than any quarter in recorded history. They've quietly begun diversifying away from dollar-denominated assets at a pace we've never witnessed before. And the smart money, the institutional players who move markets before headlines catch up, they're repositioning in ways that should make every currency holder pay very close attention. What I'm about to share with you over the next several minutes isn't speculation. It's documented capital flows, verifiable central bank purchases, and technical patterns that have proven remarkably accurate at identifying major currency inflection points. By the end of this analysis, you'll understand exactly why veteran currency analysts are calling this the most significant monetary shift since Nixon closed the gold window in 1971. And more importantly, you'll understand what this means for your purchasing power, your savings, and how you might position yourself before the broader market catches on. Let's start with what happened last week, because the significance of these moves cannot be overstated. On Tuesday, the Bank of Japan intervened in currency markets for the third time this year, spending an estimated $47 billion to defend the yen. This wasn't a routine intervention. This was a desperate attempt to prevent a currency collapse that would have triggered cascading failures across Asian markets. The yen had fallen to 162 against the dollar, a level not seen since the 1980s, before the intervention temporarily stabilized prices. But here's what the mainstream financial media completely ignored. Within 48 hours of Japan's intervention, China's central bank made a coordinated move. They allowed the yuan to strengthen against the dollar, while simultaneously announcing a new bilateral currency agreement with Saudi Arabia. This agreement, which received almost no coverage in Western media, allows Saudi oil exports to China to be settled entirely in yuan. No dollars involved. Think about what that means for a moment. The petrodollar system that has underpinned American financial dominance for 50 years just took another significant hit. This isn't the first crack in the petrodollar foundation. It's the latest in a series of deliberate moves by major economies to reduce their dependence on dollar-denominated trade. Russia and China established ruble-yuan settlement mechanisms years ago. India has been paying for Russian oil in rupees. Brazil and Argentina announced plans for a common South American currency. Each individual move seems manageable in isolation, but when you step back and view the pattern, something much larger comes into focus. We're witnessing a coordinated, accelerating shift away from the dollar-centric global monetary system that has defined international trade for half a century. The question every investor should be asking is simple. What happens to your dollar-denominated assets when the structural demand for dollars fundamentally changes? This isn't a theoretical question anymore. We're watching it unfold in real time. Let me introduce you to the analytical framework that's been tracking these developments with remarkable precision. James Rickards, a currency warfare expert who advised the Pentagon and CIA on financial threats, has been warning about this exact scenario for over a decade. His analysis of currency flows and central bank behavior identified the current pattern months before it became visible to mainstream observers. According to Rickards' latest assessment, we've entered what he calls the terminal phase of dollar dominance. Not a gradual decline, not a slow transition. A terminal phase where accumulated pressures reach critical mass and the system transforms rapidly. What makes Rickards' framework different from typical currency analysis is his focus on complexity theory and cascade effects. Traditional economists view currency markets as self-correcting systems that gradually find equilibrium. Rickards argues this misunderstands how complex systems actually behave. They don't adjust gradually. They appear stable until they suddenly aren't. They experience what complexity theorists call phase transitions, rapid shifts from one state to another that seem to come from nowhere, but were actually building beneath the surface for years. The 2008 financial crisis followed this pattern exactly. Markets appeared stable, institutions appeared healthy, then within weeks the entire system nearly collapsed. Rickards believes we're approaching a similar phase transition in currency markets, but this time the scale is larger and the consequences more profound. Because this time, it's not individual institutions at risk, it's the reserve currency itself. Here's the technical evidence that supports this analysis. The dollar's share of global foreign exchange reserves has fallen from 73% in 2001 to 58% today. That might sound gradual, but the pace of decline has accelerated dramatically in the past 3 years. Central banks aren't just slowing their dollar accumulation, they're actively reducing dollar holdings and replacing them with alternatives. Gold holdings by central banks have increased for 14 consecutive quarters. China has added over 400 tons to its official reserves in the past 2 years, though analysts believe their actual holdings are significantly higher through unreported channels. The technical patterns in currency markets confirm what the fundamental flows suggest. The dollar index has broken below its 40-year uptrend line. This isn't a temporary dip or normal correction within an ongoing bull market. This is a structural breakdown of a pattern that has defined dollar strength for 4 decades. When technical patterns of this magnitude break, the moves that follow tend to be powerful and sustained. Traders who wait for confirmation often miss the majority of the move. But perhaps the most compelling evidence comes from the bond market, specifically what's happening with U.S. Treasury securities. Foreign holdings of U.S. Treasury debt have declined for 3 consecutive years. Japan, historically, the largest foreign holder of U.S. debt, has reduced its Treasury holdings by over $200 billion since 2022. China has cut its holdings even more aggressively. These aren't temporary portfolio adjustments. These are strategic decisions by nations that have concluded the risk-reward of holding dollar-denominated debt has fundamentally changed. When foreign buyers step back from Treasury markets, someone else must step in. That someone has increasingly been the Federal Reserve itself. Through various mechanisms, the Fed has become the buyer of last resort for U.S. government debt. But this creates a circular problem that cannot be sustained indefinitely. The government issues debt to fund its spending. The Fed creates money to buy that debt. The money creation devalues the currency. The devaluation makes foreign buyers even more reluctant to hold dollar assets, which forces the Fed to buy more debt, which creates more money, which further devalues the currency. This is the doom loop that currency analysts have been warning about. And according to multiple technical indicators, we've reached the point where the loop is accelerating rather than stabilizing. Let me show you what this means in practical terms for precious metals and hard assets. Gold has traditionally served as a hedge against currency debasement. When confidence in fiat currencies declines, capital flows into assets that cannot be printed or debased by central bank policy. We're seeing this dynamic play out in real time. Gold's breakout above $5,000 wasn't driven by jewelry demand or industrial consumption. It was driven by institutional and central bank buying that reflects a fundamental reassessment of currency risk. The mathematics of gold's movement reveal something important about market psychology. This progression follows a pattern we've seen in other asset classes during major bull markets. Early adopters position quietly during the base building phase. The initial breakout attracts momentum traders. Continued strength forces institutional reallocation. And finally, the general public recognizes what's happening, typically near the end of the move. According to flow data, we're currently in the institutional reallocation phase. The retail surge that typically marks the final stage of a bull market hasn't arrived yet, which suggests, if historical patterns hold, significant upside remains. But gold is only part of this story. Silver has begun outperforming gold on a momentum basis, a pattern that historically signals the later stages of precious metals bull markets where the most explosive gains occur. The gold-silver ratio, which measures how many ounces of silver are needed to buy 1 ounce of gold, has begun declining from its recent highs. When this ratio compresses during bull markets, silver typically delivers percentage gains that dwarf gold's performance. The fundamental case for silver has become increasingly compelling for reasons beyond its monetary characteristics. Solar panel manufacturing consumes massive quantities of silver. Electric vehicle production requires significantly more silver than traditional automobiles. The artificial intelligence revolution has triggered unprecedented data center construction, all of which requires sophisticated electrical systems where silver plays a critical role. This industrial demand exists on top of investment demand. It's structural consumption that won't disappear during economic downturns because it's driven by long-term energy transition and technology trends. Supply cannot respond quickly to this demand surge. Mining production has plateaued while consumption continues rising. We've run a structural supply deficit for multiple consecutive years. Inventories at major exchanges have declined to levels that would have seemed impossible just a few years ago. This is the setup for what commodity analysts call a supply squeeze, where prices must rise dramatically to ration limited supply among competing buyers. Now let's connect these individual market dynamics to the broader monetary picture. What we're witnessing isn't random. It's the predictable consequence of monetary policies that have been pursued since 2008 and accelerated dramatically since 2020. When central banks expand their balance sheets by trillions of dollars, when governments run deficits that would have been considered unthinkable a generation ago, when real interest rates remain negative for extended periods, the value of currency must eventually adjust to reflect this new reality. For years, these adjustments were delayed by the dollar's unique position as the world's reserve currency. Global demand for dollars to settle international trade created artificial support that masked the underlying debasement. But as that structural demand erodes, as countries find ways to trade without dollar intermediation, the adjustment that should have happened gradually is being forced into a compressed time frame. Rickards describes this as the process of thermodynamic equilibrium in complex systems. Pressure builds behind a dam. The dam appears solid until one day it doesn't. And when it breaks, the flow isn't gradual, it's catastrophic. He believes we're approaching that breaking point in currency markets, not predicting a specific date, because complex systems don't work on schedules, but identifying the conditions that precede major phase transitions. And those conditions, according to his analysis, are now present. What does this mean for practical positioning? Let me share what institutional strategists are recommending to their clients based on this analysis. First, physical precious metals continue to represent the foundation of any currency hedge strategy. Gold provides stability and is increasingly being treated as a reserve asset by central banks and sovereign wealth funds. Silver offers leverage to precious metals, moves with additional industrial demand support. The premiums currently being charged for physical metal above paper spot prices reflect genuine supply tightness in retail markets. When dealers charge 15 to 20% premiums for common bullion products, it signals that physical demand is outpacing available supply. Second, precious metals mining companies offer leveraged exposure to rising metal prices. A mining company with production costs of $1,200 per ounce, selling into a $5,100 gold market, generates $3,900 profit per ounce. If gold rises to $7,000, that profit becomes $5,800 per ounce, nearly a 50% profit increase. Mining stock prices typically amplify this profit expansion by multiples. Junior mining companies with quality assets in stable jurisdictions offer the most explosive potential returns, though with correspondingly higher risk profiles. Third, strategic currency positioning outside the dollar has become increasingly important. Certain currencies of commodity exporting nations with relatively sound fiscal policies may outperform as the dollar weakens. Holding a portion of liquid assets in non-dollar denominations provides diversification against dollar-specific risks. This isn't about abandoning the dollar entirely. It's about not having 100% exposure to a single currency when structural risks are elevated. Fourth, real assets broadly deserve allocation in this environment. Agricultural land, productive real estate, infrastructure investments, commodities, anything that represents tangible value rather than paper claims on future cash flows. These assets have historically performed well during periods of currency instability because their value is rooted in physical utility rather than monetary abstraction. But let me be absolutely clear about something important. This transition will not be smooth. Markets experiencing structural shifts are violently volatile. The path from here to wherever gold and silver ultimately peak will include corrections that shake out uncommitted investors. We've already experienced corrections of 15 to 20% during this bull market, and there will be more. Rick Rule, a legendary resource investor who has navigated multiple commodity cycles over 5 decades, puts it bluntly. He expects with certainty that we'll see at least one 25 to 30% correction in precious metals before this bull market ends. Not might see, we'll see. These corrections serve a purpose. They transfer assets from weak hands who panic sell to strong hands who buy the fear. They reset sentiment so subsequent moves start from a position of skepticism rather than euphoria. The investors who build life-changing positions during major bull markets are those who understand this reality in advance. They position according to conviction rather than short-term price action. They view corrections as opportunities rather than threats. They have the psychological preparation to hold through volatility that would cause most investors to capitulate. This is not easy. Watching a position decline by 20% tests even experienced investors. But historically, selling during corrections in structural bull markets has been the single most costly mistake investors make. The ones who sold gold's 50% correction in the 1970s missed the subsequent move from 125 to 850. The percentage gains that follow major corrections often dwarf the temporary paper losses that precede them. Let me address something the mainstream financial media consistently gets wrong about precious metals. They frame gold and silver as speculative bets on fear. They suggest these assets only perform during crises and underperform during normal times. This fundamentally misunderstands what's happening in today's monetary environment. Precious metals aren't betting on crisis. They're hedging against the mathematical certainty of currency debasement. When governments spend more than they collect in taxes, the difference must be funded somehow. When central banks create money to purchase government debt, the purchasing power of existing currency must decline. This isn't speculation about potential future events. It's accounting identity. It's mathematical reality. The only question is timing and magnitude. How quickly does the adjustment happen? How large is the ultimate repricing? On these questions, reasonable analysts can disagree. But on the fundamental direction, there's no debate among serious monetary economists. Currencies backed by nothing but government promise. issued by governments running structural deficits, purchased by central banks creating money from nothing, these currencies lose purchasing power over time. The evidence of the past century is unambiguous. What we're debating now isn't whether the dollar will lose purchasing power. It's whether the loss will be gradual enough to manage or rapid enough to constitute a crisis. The patterns emerging in currency markets, the central bank behaviors we're observing, the technical breakdowns in long-term dollar charts, these suggest the probability of rapid adjustment is higher than at any point in recent memory. So where does this leave us? Let me summarize the key takeaways from this analysis. We're witnessing a structural shift in the global monetary system. The dollar's role as the unchallenged reserve currency is being actively undermined by coordinated moves from major economies. Central bank gold accumulation has reached record levels. Technical patterns in currency markets show breakdowns from multi-decade trends. Treasury markets require increasing intervention from the Federal Reserve to function. Physical precious metals markets show genuine supply tightness reflected in elevated premiums. None of these developments individually would be cause for alarm. Together, they paint a picture of a monetary system under stress, not a system that might experience problems in the distant future, a system showing signs of strain right now. The opportunity window for positioning ahead of broader recognition is measured in months, not years. When currency crises accelerate, they move faster than investors can react. The time to build positions is before the crisis becomes obvious, before headlines scream about dollar collapse, before your neighbor asks you about buying gold, before the general public recognizes what sophisticated investors have already figured out. This is the moment that separates investors who build generational wealth from those who watch opportunities pass them by. The information is available to anyone willing to look. The patterns are visible to anyone who understands how to read them. The question is whether you'll act on this information or wait until it becomes consensus, at which point the largest gains will have already been captured. I'll continue tracking these developments and sharing updates as conditions evolve. The next several months will likely bring additional confirmation of the patterns we've discussed today or evidence that causes us to reassess. Either way, you'll hear about it here with the same analytical rigor and commitment to understanding what's actually happening, rather than what mainstream narratives want you to believe. The monetary system that has defined global commerce for 50 years is changing. The only question is whether you'll be positioned for that change or caught off guard by it. Based on everything I've shown you today, the evidence strongly suggests that being positioned ahead of this transition will prove to be one of the most important financial decisions of the coming decade. The pieces are moving, the patterns are forming, and the window for action is closing. This is the reality of currency markets in 2026, not a prediction of what might happen someday, a description of what's happening right now for those paying attention. Thank you for watching this analysis. If you found value in this breakdown, make sure you're subscribed so you don't miss future updates as these patterns continue developing. Share this with others who need to understand what's happening in global currency markets. The more people who recognize these shifts, the better positioned we all are to navigate what's coming.